Hey everybody, welcome to the next call in our economic series on finances and economic wellness through COVID. For those of us who are new to Fountainhead, I'm actually not out on the West Coast. Sorry, that's just the virtual background I have here today. Today this call is being conducted by our Chief Investment Officer, Joe Halpern, and our investment team. Our investment team focuses on managing model portfolios. They source one-off investment opportunities, and they provide analysis and research for our clients on an ongoing and consistent basis. Today we're going to be talking about debt and how that's affecting us through not only COVID but afterwards. And I'm going to turn that over to Joe Halpern. And Joe, you could take it from there. And then afterwards we'll have questions and continue a conversation.
Thanks, Mark. We view our relationship as a long-term partnership, and as such, we focus most of our research and analysis on longer-term secular trends and themes like AI and the state of global demographics and how that affects growth. And then we apply those secular themes to, or I should say, we apply those conclusions, the conclusions of what we see from our analysis, to how we manage portfolios. Today we are focusing on debt, and specifically we're focusing on U.S. government debt. Roughly halfway through this year, and this is a year to remember, I'm pretty sure this is going down in the record books, 2020. We just passed the halfway mark, and thank God nothing else has happened so far, but I guess to be seen. But COVID completely shut down our economy for some period of time. And when that happened, the government very quickly came out with it was one nice thing to see everybody politically agree that we needed to bail out the economy, and quickly initiated a $2.2 trillion bailout. And odds are that there's more to come. In fact, probably end of this month, beginning of next month, you are going to have more bailout coming. There's no chance we balance the budget this year, and there's no chance we balance it next year as well. So today, we're going to explore just how far the government can go in floating our economy and some of the implications of it all.
Thanks, Joe.
Mark.
I guess I have a question. How much debt do we actually have as a country, and what's the right way to think about that number now? People just throw out numbers and randomness, but how is it that we should think about that?
Yeah, that's a great question. And what I'm going to try to do here, if I'm successful, is get a slide up on the screen to show it. But I'll start talking in the meanwhile. So the debt level we have is $26 trillion. And a lot of times, and actually I think I figured it out, so hopefully everybody could see there, that is the first national debt clock. It's in New York City, seedier time of the city. There it looks like it says about $6 trillion. Now we're up to $26 trillion. And when you think of that number, it's like, wow, that's a really big number. But we do have to take it into some level of perspective, right? And so the typical way people look at it is, what is the level of U.S. debt related to GDP, which is the gross domestic product, right? And so GDP stands for all the production we do as a company, not only the goods we make, but the services we provide, right? And I kind of pointed in my squiggly arrows here, US GDP. This is actually, it's a great website. Now we're all digital. We don't need those clocks. You don't need to go to Times Square anymore. You can live wherever you want and find out what the debt level is. It's usdebtclock.org. And here you see the US GDP is $20 trillion. So U.S. national debt right now is approximately 1.3 times GDP. And to put it into further perspective, I'll go down a little bit. This top chart here is how much debt we've had as a country over time. So we haven't had this level of debt since 1945, and there's an obvious reason for that level of debt, which was, World War II. One other thing I'll just kind of comment before moving it on, is you could kind of almost think about it as a household, right? So if a person takes debt, they have a level of assets, they have a level of revenues and cash flow, and that GDP kind of looks like revenue, how much you're making a year. So we're a little high right now. And of course, the question will beg, how high could we go?
Right. So people think about, debt as credit cards, is it's just going to spiral out of control. But I mean, how much debt can we take on? Can we double it? Can we take on another 26 trillion? Like, these numbers are so big, it's hard to comprehend what they actually are.
Yeah, no, it's a great question. It's a great question, right? And so if you think of, I'm going to flip ahead here, really. So when you think of the risks of debt, right, and I'm going to take this kind of two ways, right? So one, when you think of risk of debt, one is, can I return that debt at some point in time, right? So general risks of debt, which is on the bottom of the screen, right? Principal borrowed, and then can I pay the interest on the debt, right? Those are the two items that you really care about. And when you look at our interest payments, which is really interesting, because interest is so low, right? Our debt burden from an interest payment perspective is actually we're kind of right there in the middle, if you see that chart. And the truth is, considering interest rates have even gone down more and we're close to 0%, over the next 2-3 years, as long as interest rates remain there, we're actually going to be on the low side from a payment perspective. So that's answer number one, which should make everyone feel pretty good that we could afford this debt. And then answer number two.
But that's from a cash flow statement, right? That's more of a cash flow perspective, we can afford it. But from then the part two, how much more can we take on and, eventually also pay? Are we paying only interest here? Are we paying principal? Like, how does that, or are we just continuing to accumulate? How do we look at that?
Yeah, it's the beauty, right?
Anything,
It's right. It's like doing a 30-year mortgage and then interest only, and then just keep on rolling it, right? I think I want to keep that part of your question and kind of push it off a little bit in terms of like, okay, how does this end and what really occurs, and kind of focus more on, can we borrow more? Can we borrow another $20 trillion, right? We kind of opened remarked here with, we're definitely going to borrow more, right? And so the question is, how much can we do? And so we do have, we're lucky enough in a world just, I think, kind of drowning in debt, that we have a canary in the coal mine. And that canary in the coal mine is Japan. So Japan has 3 times, when you take that debt to GDP level, which is how most people look at it, Japan has 3 times the debt level of the US. And Japan is not in as good a position as the US. So you would think, just simplifying everything, that we could take out more debt than Japan. And that's probably the easiest way to say, all right, we could easily take on more debt. And I'll leave it at that for a moment, just to see if where you kind of want to go with that.
Well, let's get back to Japan in a second. But who actually owns the U.S. debt? Let's go back and talk about that for a second.
Yep. Yeah, sure. Yeah, no worries. We could put Japan on the back burner for the moment. So here's a graph of the U.S. government debt holders. Federal Reserve and intragovernmental holdings and other government accounts. That's all the government loaning to the government. And it feels really funky. And every once in a while, right, so that's 50% is right there. And every once in a while, people say the government owes Social Security money. And people sometimes think of that as, oh, wait, how did that work? Did they just, the way I've always heard it in the past, is it almost feels like the government took $2 trillion away from Social Security to pay current items. But it's not true. Social Security is a pay-as-you-go system. So every year they balance it out. And what ended up happening was 20 years ago or 30 years ago, there was a surplus, right? And what that meant is the government collected, let's say, $2 trillion, and they paid out, based on their obligations, $1.5 trillion. By law, within the bylaws of Social Security, the surplus has to be put into U.S. Treasury. Now, everybody talks about Social Security running out of money, and that's because we have an aging population. So in 2030, 2035, they all think, okay, it's going to start going negative, meaning that we're going to bring in $2 trillion, we're going to owe $2.25. At that point in time, Social Security is going to sell those treasuries. The next biggest holder are foreign holders, which is really interesting, right? Foreign holders own close to $7 trillion of our debt, And you could look at that and say, huh, do we really want that, right? What does that mean? Japan actually, not to bring it right back to Japan, actually owns about $1.5 trillion. And China actually, because I know we haven't been so friendly with China lately, actually holds about $1 trillion worth of our debt.
So, I mean, $1 trillion sounds like a lot, but on a scale of 26, it might not be that much. What if they just sold that debt? You know, what happens then? Because we've heard, people have like inferred, what if China decided to, attack us economically that way? Would that affect us? How would it affect us? How would you see that playing out?
Sure. So we'll be fine, first of all. And it probably would hurt China more than it hurts us. And the reason is that we have the biggest consumer base in the world. We spend the most money. It probably doesn't surprise anybody here on the call. We love spending money, and we're a huge base. We are roughly half of the world's global economy, and we probably spend more than that, right? And so because of that, we import a lot of things. And not surprisingly, everybody on this call knows, we import a lot of things from China. Well, all that is in US dollars, right? And so China always has to be concerned with the currency rates. And by holding $1 trillion of US government debt, they're helping in that export-import equation. So ultimately, China steps away and says, you know what? We really don't like US. We're in a big fight. We're going to hurt you economically. That $1 trillion is going to get vacuumed up by the Fed Reserve. It's almost not going to do a thing. I'm sure the markets won't be happy and lots of people won't be happy. And there's other implications that we could go into. Hold it off for our conversation around inflation, deflation issues. But ultimately, it's going to hurt them on just currency risk that they have. And it's a little bit of a drop in the bucket.
So you talk about currency, okay. One of the things is the U.S. at risk of losing its stance as this flat currency. And China, we'll stay with China for a second. What about them picking away at it, starting to transact in their own currency and take U.S. dollar out of play? Yeah,
so 70% of global debt, not U.S. debt, right? 100% of U.S. debt, 70% of global debt is U.S. dollar denominated. We are the fiat currency for the world. Everybody uses ours, right? And the question you're asking is, right, China's been moving up. They're about half of our GDP, so we're about 20 trillion, maybe they're about 10, 11 trillion. I think Japan's number 3 at about $4 trillion, right? So they're really a big economic power. What's really interesting about China is that despite the fact that they have the second largest economy in the world right now, they are considered an emerging market, right? So when you break down financial markets around the world, you have developed markets, emerging markets, frontier markets, and then I don't even know what you'd call what comes out after frontier markets. It's like, don't put a penny in there regardless, just don't touch markets. I don't know what the technical term is. Developed markets right now are the US, Europe, Japan, Australia, 1 or 2 others. China's not in there. The reason they're not in there is that they don't have the appropriate checks and balances where the world can be comfortable with them from a dollar standpoint. So there's no chance that China is replacing us as a fiat currency. This is not a technology fight like we're seeing now with 5G, which we could talk about too at some point, right? On the money side, Europe's never using, they're never replacing dollar with yuan. They're just never doing it. And Europe's a distant. They have too many problems within the EU to pick it. So right now we're the default, and we're a very comfortable default. Nobody is touching us from that standpoint.
Okay, interesting. So going back now to Japan, you just mentioned Japan's the 3rd largest GDP. Okay, but their debt, and they have 3 times the amount of debt we have, and all we hear about is Japan can't grow, Japan hasn't grown. Is that tied to their debt? And is that something that we worry about? And then I would add on to that is like a tie-in question. What are the risks of us taking our debt, even if we can take it from 25 to 50 trillion or something along those lines, something staggering like that? Yeah,
so item number 1, cause and effect is always really complicated. The one thing we know about Japan is, and we spoke about this, by the way, I think about 3 explorations ago, we talked about demographics, and we showed all these population pyramids. And what a population pyramid basically does is it graphically, I wish I had a chart of it here, it graphically illustrates, I don't have one. It graphically illustrates how old the population is. Japan has a really, really old population, one of the oldest in the world, right? And they also have no real immigration. And so between that, they just don't have growth. And in fact, over the last 20 years, there's been a lot of deflation. And it's basically been flat. There's been some deflation, there's been some inflation, but it's basically been flat. And the BOJ, the Bank of Japan, has tried over and over to kind of get things going, and they just haven't been able to. But I think it's really more of an effect of very old population, low growth society that has that has really affected this, as opposed to the debt being a burden. Now, the debt's definitely a burden, but I'm not sure. I'm not sure that that's the cause of their lack of growth. And then going to what was the second part of your question? How much?
Well, the follow is what are the risks then from our perspective? What are the risks of carrying this debt that we are currently carrying? And what's the risks if it does? I guess the risks will still they would just increase if we double it. So.
So the real risks we have are flexibility, right? We came into this event, COVID, which we had no way of knowing, what was coming up, right? And we needed money, right? We needed to get money out there, and we still didn't kind of complete what we needed to from what happened in 2008. So we didn't have that level of flexibility, and kind of, to probably the best example to use to illustrate what that means is I keep on closing my chart here. Here we go. Is this interest number, right? So 1970s, 1980s, interest was really high. And you think of inflation, the best way when inflation pops, the real way the Federal Reserve gets around it, and it's one of their key, it's their mandate. That's what one of the key reasons they're around, is to control inflation. The way to control inflation is to raise interest rates. Well, if you raise interest rates 1%, you have exponential growth in debt burden, right? In that debt interest burden, which is really problematic. So all of a sudden it becomes harder to use tools. And as you can see right now, we're at really low interest rates. It's like, well, what do we do next, right? We're kind of flushing the system with cash. So it hurts our flexibility. So the answer is, part one, can we spend more? Yes, we can spend more. We could spend the next $1 trillion that we're going to come out with. We could have an unbalanced budget, but at some point we need to get out of that, right? And how do we get out of that? We need to grow ourselves out of there. I'm not sure, but we need to have some decent, relevant, probably a decently lower level of debt, most likely. There's, you're getting into economic theory here, and I'm not going to touch it because there's big arguments over how much debt we should actually carry. But suffice to say, lower debt levels allow you to have more flexibility.
So, at these debt levels and with all the debt flowing around the world, interest rates are so low. Are they being kept low on purpose for that? Is that a problem? Is that with interest rates? Because obviously you just said if interest rates come up, that's a problem in terms of debt servicing. Are interest rates being manipulated too low? Are you concerned about interest rates right now? Where are you on that?
Yeah, so here's a 200-year chart of interest rates. It's back a couple of years, but just to give perspective, I like showing this because a lot of our clients, 1970s, 1980s, it was a bit of a tougher time. And as you can see there, 1980 was, over that 200-year period, not only an all-time high, but dramatically higher than any other period of time. And now I'll pop down to where we are now, which is incredibly low compared to even a year ago, right? And so the first question is, how are they, what's the danger here? Are they artificially low? So part of the answer, I think there is some artificial element to it, but I will say that the world has been in a really low growth environment for a very long time. And if you think about it, there's negative rates out there, right? The EU has negative rates, Japan has negative rates, and part of that is artificial, but part of that is the fact of having deflationary effects there, right? So if you think about it, if someone puts lends money to Japan, like to let's say the Japanese government for 10 years. They give them $1 million. They're getting back 999,500. That sounds terrible. You kind of think, who in their right mind would do that? But if it's deflationary over that 10-year period and everything's worth less, it's actually, there's actually a return. And it's a really hard concept to get around. But inflation, you know, they're all connected. Inflation, interest rates, growth are all connected. And so ultimately, with growth really low, you tend to have low inflation. You sometimes have deflation, which you don't really want. And to get out of deflation, you create easy money so people have more money to spend to try to get inflation going again. And so there you go. And then the artificial part in the US right now, the only part that's really quasi-artificial is that Fed fund rate, which is super short term. You can think of it as an overnight rate. They're talking about trying to put more control over the first 3 years. And obviously the Fed is buying US Treasury, right? They're buying their own, so they could affect it a little bit through supply and demand. But ultimately, most of the curve right now are people just placing their money in cash. Like when you think about it, right? And I'll go back to the holders because we didn't focus on all of it, right? There's $2 trillion of US Treasury in mutual funds. And the question is, why is that? Well, that's basically cash, right? If you put it in the bank right now, you get zero, right? If you put it in a money market fund, well, that money market fund is holding US Treasury, right? And so, you know, just to give you an idea. And so going back to artificial, I also believe the system was created, like banks have to, from a regulatory standpoint, put some amount of money in Treasury, insurance companies, pensions. So you do have a system which kind of allows it. So I do think there's a little bit of artificial around it, but it's not so crazy. Like this isn't a full artificial story because of where growth is and inflation and deflation.
Okay, thanks. So then I guess a follow-up question I start to think about, so that's the US and the US system and how much, you know, debt that we're holding on our own, but are all risks the same for different countries, like debt risks, carrying debt? We see if Japan is slowed up, not 100% by their debt, but what about, you know, countries like, you know, Greece, you know, when the problems they ran into, or even Argentina, you know, and they're still not a part of the international debt markets. How does it affect other countries versus the US? And then I'll have a couple of follow-up questions off of that.
Yeah, sure. So the US, you know, and it's interesting, we speak about it on every explorations that we have a US bias. And, you know, we looked at it, it's day one, like call it 2 years ago, right? And sometimes the simplest questions are the best questions, right? We had a little bit of a US bias just simply because we're in the US, we should have a US bias. And then the question is like, well, why? Why should we have one? And you start looking in every exploration we do, we look at a global level, like, okay, how does AI affect the world? How do demographics affect the world? Every single one of these, the US comes out shining. And I think it's important to say, because I think we're a little beaten down nowadays in the US with, you know, there's no question, there's political polarization, there's, you know, we're not doing a good job on COVID. But at the end of the day, there's so many amazing attributes about the US, and some of them are natural, so we're just lucky, like the fact that we're sitting where we're sitting geographically. And going to your debt question, right, and I kind of pulled up a slide, the haves and have-nots. The US and the EU and Japan, we're haves, right? And the reason we're haves is because we could print money. We have a system on our own, right? And beyond us printing money, we're a very wealthy country. So beyond, you know, printing money is not a great solution because it introduces inflation. But ultimately, what it means is if you look at the 4 ways to combat a recession, which is cut spending, reduce debt, which is austerity programs, right? Both of those are austerity programs, and we'll get to Greece in a minute. Redistribute wealth, print money. The US doesn't really ever have to do an austerity program until, going back to your question, we take that extra 20, 40 trillion and the world collectively almost decides, you know what, too much debt, we can't give it, we don't trust the government enough to allow them to kind of lend to themselves. So someone like Argentina, who defaulted 20 years ago, they really have not been allowed back in yet, right? And so, and they have limited resources in their home. And for them to do any business outside, it has to do in they have to do it in dollars. And so they really don't have that many choices. Greece, they kind of answer to the EU. They're not as cohesive as we are in the US. And so the EU forced them to do some austerity program because the EU does not actually have control of the printing press, right? None of those countries do, even though you could argue that Germany probably does because they're by far the strongest economy out there in Europe. So again, we're a have. A lot of these emerging markets are have-nots, and so they don't have as much flexibility as we have.
Okay, thanks. And then regarding the EU, any concerns or any changes there and thoughts going forward with Brexit and England breaking away, or is that not going to change that much on a global scale?
Yeah, I personally used to just think, I just never saw how EU gets there. We actually yesterday had a meeting with one of our developed market managers. He actually is from the EU. The EU, I think it's here to stay. I think I was wrong with my initial thought. It seems like, and even when you look at London, and I'm no expert at this, it seems like the younger generation voted against Brexit for the most part. And it seems like over the last 20, 30 years, people in the EU have become more, I'll call it pan-European for lack of a better word. I don't know if that's technical at all, as opposed to being like, I'm from France and I don't care about anything else, not to put any words in their mouth. So I think they really got over a hump after 2008, like during the periods of time when they made Greece and Italy and Spain go through austerity. And I do think the EU is here to stay, but I think they have their issues. But they're.
So you talked about we're U.S. biased. You talked about like what you love about the U.S. How does this now? We've talked about debt, I think, pretty extensively. How does this affect the way we construct portfolios? How does this affect the way we look now at investments and when we're building our portfolios from, that overall construction? Yeah,
it's a great question. So I take it back to this chart. Right now, and I'm going to just read this off, June 30, 2020, no, we'll use June 30, 2030, right? So that's a decade from now, 10 years from now. If you buy a 10-year U.S. Treasury on the day that I guess this was on July 6th that we took the snapshot, the yield on a 10-year Treasury is 0.66%. That's really anemic. That means if we go and we buy it in someone's portfolio, every year they're going to get a coupon of 0.66%. And then the next part of that is, okay, well, if that yield goes from 0.66 to 0, right, then you could do the math. You do 10 times 0.5%, which is 5%. So you'll make some more money on a portfolio that generally holds a 10-year maturity, right? But the same way you do that math, if it pops, if it goes from 0.5 to 1, right, you're going to lose 5%. So that feels really bad, right? And what we did when this occurred, right, a few months ago, was there was actually an opportunity where some of the riskier products out there really traded to levels that felt really juicy, and we converted the portfolio and became a little bit more risky because of where the levels were. So what I mean by that, if you think of something like high yield, if the world is expecting 25% of high yield securities to default, right, then they price that in, right? And so if you buy it on the day when the world believes 25% of the world will default, and that happens, you don't actually lose any money because it's already priced in. But then if less than 25% default, then you make money, right? So we were willing to take that bet. And in some ways, as the world believes that this amazing amount defaults, it actually becomes less risky because, again, it gets priced in, right? The question is, once that stops, and it has been playing off, over the last few months, where now the world thinks, okay, maybe only 10% will default, where do you go? And, I wish, Mark, and to every client on the phone, I wish we had an answer to that. I don't know if anybody does, but what we're doing is we're looking at that really closely as where can we put the fixed income component to work to where, A, it's a lower risk than equities, so ballast for the portfolio, but where we can still create a total return for that client. And, recently we have introduced a few, a few one-offs that we think are really good, and we're diligently looking at, okay, how do we do that? How do we kind of balance that, call it ballast for the portfolio versus total return? But I'll say one last part about it, right? Everything in the world from a return perspective works off that risk-free rate, right? And so the same way this is lower, equity returns are expected to be lower, but because growth is lower, you could also say that inflation is expected to be lower as well, and hopefully it stays low. And so it still means more bang for your buck, even with slightly lower returns in the future. Not a great answer, but hopefully, but that's what we're dealing with.
Thanks a lot, Joe. I think, you actually answered my final question, which I was going to ask you also about returns and how, the debt's going to, potentially affect returns. And I guess not only in the fixed income and part of our portfolio construction and things that we look at and, one-off investments and things that we've been doing some research on. But I guess, are there any final things or final thoughts you'd like to summarize, or any final points regarding, how we're looking at this debt on a going forward basis before we wrap up here today? I ran out of questions here also. Everyone asked questions.
No worries at all. I'll share a couple things, one or two about debt, and then one just about China, because China's a little bit on my mind, and you had a couple questions to it. So I'll start there. Well, I think China's going to hold on to that debt, and the truth is, if they didn't, it wouldn't be a big deal, even though from a political perspective, it'd be a big deal, but it wouldn't be a big deal beyond that. We're kind of entering, it feels like we're really entering a Cold War with China. You see everything around Huawei, which is 5G and next technology, and both, and we've kind of come down to both countries basically drawing a line in the sand and saying, hey, all of our partners need to use our technology or their technology, and you might have what used to historically be one global internet and one global technology, where now you have two closed systems, which is problematic on a lot of levels, and it's something we're actively exploring, within that. But where I was going, and sorry, I lost my thought for a second on China and the 5G and the breaking up, well, I guess I'll come back to it since I'm having a senior moment. I'm too young for this. So I will go to the debt thing, and I'll come back to what I was going to say about China and 5G, if I remember. Right now, if you think about the debt, what I'll call an issue, right? And I do think we have a lot, and we could do more. It's right now, while the world is awash in debt, every single country out there has a similar kind of level of debt that they're holding. And because of that, it's really hard for anybody to say, okay, the U.S., right, Japan being that canary in the coal mine, Japan, you got to lower it. You got to get rid of that burden, decline the burden, decrease the burden. So I think we really do have some room on that. When you think about debt is not all bad, right? This debt was one of those, like, you could think of it as a rainy day fund to cover it, but a lot of debt is just a way to spend, right? And if you think of ways to spend, like if the government tomorrow said, hey, we're going to take $1 trillion and better our roadways, well, that should be beneficial, because that would create efficiencies in our roadways, which would allow us to increase GDP. If we spent $1 trillion on education, that would potentially give us, our children better, more potential to innovate and develop, et cetera. So I think it's really important to look at that and say, listen, not all debt is bad, right? You take on debt to do something, and if you're doing something which gets a good return, especially now, right? The return doesn't even have to be that high, right? Because the government could borrow at 1%. If they have a return that's better than 1%, then you get growth in the system, and with growth, your debt declines, right? Because you're making more GDP, you're collecting more taxes, and it's all great. So I think it's really important to understand that. But of course, debt has its downsides, and the big downside is that flexibility, and that's something we're going to watch. And this brings me back to China, because it's all interconnected. So I finally remembered what I wanted to say. So if you bring it back to China, right, and we end up creating these two worlds, right, and you start pulling away from globalization, and we spoke about this in a previous exploration of the world becoming more regional. Well, if you start pulling back from China really quick as opposed to allowing it naturally, then you could start having costs increase, right? So you take probably 2/3 of the people on this call have Apple iPhones. Well, Apple iPhones going up $50 in cost, everybody's still going to buy it, but that going up $50 of cost introduces inflation, right? And if you have inflation introduced, interest rates go up, and then that's a problem with debt. So it kind of goes full circle. And so that's why I kind of pulled up that whole 5G and this whole Cold War with China, because as we move away from China, you could start having cost creep, which could create inflation, which could create issues for our debt. And to me, that's probably the foremost issue I see, as opposed to having too high a level of debt.
Thanks, Joe. I think that's great. And the final point on good debt versus bad debt, I think, was really interesting, because that's one of the things that we traditionally talk about with our clients also. It's like, debt, mortgage on a house, good debt, credit card, bad debt. It's very simple. So I could see how that plays in. And so I think that will, unless you have anything else, but I think that's it for today's webinar. And I appreciate it. Appreciate everyone here who's listening. And if anybody has any questions, wants to follow up questions, anything one-off, feel free to reach out to either Joe or myself, shoot us an email, and we'll do our best to respond and get back to you in a timely manner. Hope you're all doing well. Everyone stays safe, and we'll see you shortly. Talk to you soon. Bye.
Thanks, Mark.